Hello and welcome to Landlord Coffee Talk, proudly presented by the Southern California Apartment Group, Sean Sherbetchian's office, your trusted expert in multi-unit properties. I'm Mary Sherbet, serving as the Marketing Director at Southern California Apartment Group. We recognize that investors frequently encounter similar questions, and in light of this, we've decided to broadcast and share these common inquiries with fellow apartment building owners such as yourselves. Our aim is to provide valuable insights and solutions to address these concerns, just as we've done for our cherished clients. Join us for our informative 20-minute Q&A fire rounds, where we aim to provide answers to those burning questions that have been on your mind. Welcoming Gil Figueroa from First Commercial Capital, multi-unit loan specialist. Welcome, Gil.
Thank you, Mary.
How are you
Thanks
doing
for having
today?
Me. I'm great, fantastic.
I love having you here because we're so ready to dive into this one case study that we've got going on. A lot going on with this one. We're hearing this happen often. But before we do, tell me a little bit about yourself.
Wow, been in the mortgage business since 1991. They were double-digit interest rates then. I remember my processors working on a typewriter.
Oh my gosh.
So things have changed. We did multifamily and single family for many years. In 2006, we decided to completely change our forum and only do multifamily commercial loans.
Yeah.
And we've done 6,000 transactions since.
Wow.
Everything from 5 units to 500 units, from business SBA, commercial retail, all across the forum.
Amazing. Well, your expertise is really impressive, and it just really does encompass everything related to multi-unit loans. So usually we do a Q&A fire round, but this is actually very interesting. I'm going to do some sort of a common case we're getting right now in Sean's office, and it's not really a question and answer fire round. We are going to get some questions within it, but this is what's happening now, and a lot of phone calls that are coming through right now. And Steve is a client of ours, and 4 years ago, Steve purchased a 10-unit property in Montebello, okay? And he used his maximum allowable loan dollars to purchase this property. So within the next year, the loan is coming to reset to the current market rates now. What is going to happen to Steve's monthly loan payments?
Well, Mary, the majority of apartment buyers and multifamily buyers have picked, there's an array of product line, 3, 5, 7, 10, even 30-year fixed.
Yep.
But the most popular one's a 5-year fixed. So I'm assuming Steve picked a 5-year fixed.
Yep.
So his product more than likely is a hybrid product. And what I mean by hybrid is they're fixed for a certain period and then adjustable at adjustment. Typically, most of the adjustables now are tied to SOFR. SOFR index is at 5.4 today.
Wow. And
the typical margin could be anywhere between, this is a lender margin that they add to the adjustable program. It could be anywhere between 3 to 3%. So let's just say the average margin is 2.7. That means his fully indexed rate at adjustment could be as high as 8%.
Okay.
Yeah, so almost probably double.
Right.
Double from where he was before.
Yikes. So can be potentially looking at double than what he was before, like you had mentioned. So,
yes.
So for multi-unit, for apartment building owners, let's just call it that, property owners, rental income is a key source of cash flow, right? If interest rates rise, and you basically mentioned they lead to higher loan payments, and in Steve's case, possibly doubling, it may impact the property's cash flow, potentially making it challenging to cover operating expenses and generate a profit, right? So how would this affect Steve's cash flow?
Well, in essence, the apartment owners in the last 4 years had the benefit of tremendously low rates, the lowest rates we've seen in history. That was a 22-year cycle that ended, with treasuries at lower than 0.5%. Now they've raised to almost 5%. So we're almost at 5. We're at 4.95 today on the 10-year treasury. So rates have gone up tremendously. His cash flow, in essence, is going to be injured. More than likely, he didn't have the opportunity during COVID to be aggressive with his increases.
Exactly.
So chances are he's going to be in a deficit.
Right. So that was one of the things that Steve brought up is my hands were tied.
Right.
Because due to COVID, I wasn't able to increase my rents as
Right.
I estimated to.
Right.
Now with the double of the payments, now we're looking at some sort of a cash flow that's not possibly going to be favorable.
Absolutely.
Okay.
And what we really promote is the fact that we need to be proactive with the situation.
Right.
Speak with Steve as soon as possible. Talk about all his options.
So let's say Steve could easily pay this resetted premium, right? Steve is easily adjusted mortgage payment after the reset, can pay it. But on paper, the cash flow doesn't show well, right? So does that trigger anything with the loan, the lender?
Yeah. So what happens is all lenders have a hurdle rate that are part of the loan document. So if you qualified based on a 120 debt service, for example, then that particular loan will have to keep maintaining that 120 debt service throughout the history of the loan.
Right.
That's why lenders ask for either quarterly or yearly statements as far as P&Ls are concerned. So if he doesn't meet his debt service criteria, they will put him on a watch list, okay? And eventually a special agent from the bank will call him and talk to him about what are you going to do to cure this.
Okay.
So are you going to raising rents? Are you interested in buying down the rate or maybe even paying down the mortgage?
Wow.
So there's going to be different options that they're going to want to hear that he has some type of strategy.
Got it. Now, you want to stay proactive and not really get that phone call from that special agent and be able to know what you're going to do prior to this reset. You'll have more options then than you would with a special agent? Is that how it works?
Well, let's talk about timing and our market now.
Okay.
So in today's market, we have an inverted yield curve, which means that short-term loans are higher than long-term loans.
Right.
So, and hence, if treasuries are 4.9 and the SOFR's at 5.4, short-term is higher by 0.5%.
Yes.
So there could be an opportunity to refinance now at a lower rate. Some banks are in the low 7s now compared to an 8. That's a little better. And what we've been doing is we are offering interest only as well to mediate the problem. Okay, so interest only is almost equates to about 1.5% less on the actual payment. So that's a way to mitigate problems. Now, sometimes, like me and Sean just had a situation where I brought these options up to a borrower, and he wasn't happy with them. His cash flow was still dwindling, and he decided the best position for him to do at that time was to sell. So that's something that you need to talk about now, and I'll tell you why. When this problem becomes an issue with a big percentage of the population, there's a chance there's going to be a much more inventory.
Right.
So the market doesn't have much inventory now. So that is a perfect time to sell if this is a time you're looking to do it.
Right. Because otherwise you'll be subject to properties on the market and you go, okay, more inventory for me.
Right, there'll be more inventory. And what happens when there's more inventory? More choices and prices come down, right? So prices soften. So keep that in mind. Also, the interest rates, the trend is not ending yet. Okay, so we're still looking at higher rates.
Yikes. Going back to Steve, the case study here. So now he is on the watch list, or will soon to be on the watch list, watched by the special agent, let's say. Again, Steve is in a good cash position still, but on paper doesn't look so well. Being that one of his properties is not cash flowing well and doesn't hit that debt ratio, would that impact his future investments going forward in getting loans? Would other lenders look into this and say, hey, that one property of yours on your portfolio is not doing well?
Right, right. Typically, lenders consider this a very private matter.
Right.
So it doesn't get out and exposed to the public unless the lender exercises their default acceleration clause, which basically says, you are not debt servicing and you need to. So if you don't, we're going to call the loan due and you're going to be in default in essence. Now, I have not seen that happen in history. And I've been around them for a long time. And I believe, frankly, not to scare your public, because I think that the problem is going to be so big for so many that I think lenders are going to be considerate to a certain point. Okay. And what I mean by considerate is going to work with people. But the same token, the FDIC looks at these loans that these lenders are carrying as non-performing.
I see.
So for the smaller banks that don't have the resolve or the ability to reserve for this kind of problem, hence could be a bigger problem for banking. So we expect some problems to come up. I think right now is a great opportunity to talk about either a lower rate, a refinance, potential sell, potential trade. But let's talk about it. Let's deal with the reality of what's coming.
Right. So
have a game plan.
And have a game plan. So that was my next advice. So we've got Steve, obviously, with his loan resetting, and Steve's not the only one in the market with a loan that's resetting. There was loans given away 4 years ago, with the next year to reset. How does Steve and those like Steve stay proactive? What is step one for them?
Step one is call us.
Okay.
Let's get on a phone call.
Yep.
Get a copy of your promissory note, your deed of trust. Let me see it.
Okay.
Let me see what our adjustments are. Some loans adjust more than others.
Okay.
Okay. Some have balloon periods where they adjust dramatically, 5% on the first adjustment. Some only adjust 1%.
Right.
So depending on their product line, it's going to determine a game plan.
Okay.
Right. So if their product line doesn't change much, maybe they have a year or two to watch rates. Okay. Potentially see if something happens in the marketplace to benefit them. Right. But at the same token, they need to look at worst case, best case scenarios now, so they're not surprised in the future of what's going to happen.
Okay.
And if this is a time cycle for eventually maybe selling, or they're having their their loved ones and so forth transfer assets or so forth, this is a good time to do it.
This is right now. It is before we actually start.
Yeah.
We get there.
Before we get there, and there's a lot more people that would need to sell.
Sure.
And when people need to sell, we know what happens. Prices come down.
Come down. Exactly.
Right.
Yeah. We talked about staying proactive and ahead of the curve, certainly, and the curve. Let's talk about the curve and the forecasting of this. So I feel like the goalpost keeps moving, especially with loans, and you've sort of figured out a way where you're forecasting these interest rates. And I'd like for you to talk a little bit about what you've done, which is, I think, incredible.
Sure. So, been in the business a long time. I realized that interest rates are part of my livelihood.
Yeah.
So from the very beginning, sometimes we'll have a client that says, well, I don't want to lock. I don't want to lock the rate. I want to secure it during the transaction. And then the rate bumps up and the client falls out of the transaction.
Yeah.
Right? So in other words, I've always found a need to give them information to make them feel good about locking, or maybe in certain situations, maybe they do float, right? But my point is, I needed to have data, because what I didn't want to have, and what we don't have now and haven't had for years, is any fallout. So when we speak with a client, we tell them, hey, this is what we can deliver more than likely. We can get you locked in as soon as possible. Here's why you need to lock, okay? And then I'm a technical analyst, so I show them a 10-year treasury chart, and I show them the direction of the market and what's projected next.
Got it.
Okay, so that's what I do. Most clients don't want to even get into the chart. Some do. Some are a little more proactive on that case. Some don't. They just want to hear my opinion. There's times where we've asked people to float. Okay, so in other words, in 2018, when Jamie Dimon and everyone else said rates were going to go up, we said, no, they're not. They're not going up. And they didn't.
And they didn't.
And they didn't.
Oh my gosh.
So that was a great forecast. So we asked people to float until they're ready to close. So in essence, that's been very beneficial for my business and my clientele.
Amazing.
So right now we have a loan that we're closing for Shant.
Yes.
That I pounded the table for the client to lock immediately at 6.6,
and now
6.6, and today it's at 7.4.
I was just going to say that.
That's a big difference. On a $3 million transaction.
Huge difference.
That's a big difference.
Yeah.
Right.
Wow. And you have a copy of this chart?
Absolutely.
Okay. Well, you heard it, folks. There is a crystal ball chart available that displays future interest rates that our expert Gil has created. And there is a way to get a copy of it through our dedicated text hotline. Shoot a text over to 626-650-9547 asking for a copy. Now, we've just begun exploring today, but there is a wealth of information still available, but we don't have enough time. I mean, we could be here for hours talking about case studies and what's really coming across our table at Southern California Apartment Group. Again, we've set up a dedicated text hotline where you can submit these questions. Our team is committed to providing a response within 24 hours, and one of our experts will be ready to offer guidance. If you have any questions or need additional insights, you can also give our office a call at 626-657-8150. You'll find our contact details in the description below. We are here to help. Thank you so much all for tuning in. Thank you, Gil, for joining us today.
Thank you for having us.
Amazing. Yes.
Yes.
Here's to more.
Salute.